again, coming back to the problem about negative correlation, you saw last March 2020, where equities obviously had a bit of a tumble because of COVID. Fixed income didn't do a great job of protecting portfolios. The way we sort of think about the world, and I'd love to get, again, this would be a good discussion, but the way we're thinking about the world, as Frederick said, is inflation is particularly the number one topic on people's minds and what impact that has for multi-asset investors. So the scenarios we're sort of thinking about we have three scenarios that we think about. Sort of scenario one is the Fed and most central banks are correct. Inflation is essentially going to be transitory, and really, equities remain pretty well valued compared to where fixed income yields are today. So equities will remain attractive. Fixed income won't do a lot, it'll essentially stay around where it's today, and markets will continue sort of on their merry way, sort of scenario one. The scenario two and three essentially are starting to saying, okay, what if inflation is a serious surprise on the upside? How will that impact those markets? So scenario two is inflation surprises, but central banks don't do anything. They sort of sit and watch. And that could be pretty painful for many investors. It could be very good for commodity markets. And sort of Anna mentioned sort of the role commodities are now starting to play in portfolios. But then scenario three is, again, inflation surprises to the upside. But you get central banks being very reactive and essentially raise rates much faster than most investors are seeing. Now, in scenario one, as I said, equities and bonds should do very well over the medium term. But in scenarios 2 and 3, we think equities and bonds will both do very poorly. But in scenario 2, I guess, where central banks don't move, commodities will do pretty nicely. But in the example where Fed's quite aggressive, even something like commodities could struggle. So it's a pretty difficult environment. And actually, we've given some rough probabilities how Social and the macro team are thinking about it. They sort of give about 40% weight to scenario one, that inflation remains pretty transitory, but then a 55% weight to scenario three, where inflation actually looks like it may surprise to the upside. But then central banks will react much quicker than investors are thinking about. But again, an interesting topic is how you guys are thinking about the problem of higher correlation between equities and bonds, and what else you're trying to put into your portfolios to answer that problem would be a really neat topic to touch on.
That would be the perfect intro for Frederick Fischer, I guess. Already smiling. Because you have added more exposure to commodities, I guess around 10% currently. How do you allocate this in your portfolios, and why are you, let's say, positive on commodities?
Yeah, maybe first speaking about the correlations, I mean, it's a very interesting observation. Also the derivative side now for multi-asset derivatives, the implied correlation between the equity and the bond market is declining, and is now a little bit more than or from a negative side, a little bit less than zero. So basically, the big question is whether the old correlation patterns will remain, or whether they completely will transfer into a new regime, and we will have actually a positive correlation between equity and bond markets. So that is the big question going forward. And speaking about commodities, I mean, in what macro scenario would that be the case? I mean, that would be the case in terms of central bank policy keeping interest rates close to zero, and then basically markets are driven by inflation fears, and that's what we have seen during the last couple of weeks, and we believe also that this can persist for quite some time, as we have huge challenges in the global economy in front of us. And one big topic is decarbonization of the global economy. So basically you have to transform the whole economy globally. So basically getting rid of fossil fuels and transferring to renewable energy. And this requires a lot of infrastructure spendings. And here we are speaking about commodity demand, basically.
About inflation and dealing with rising correlations, Matthias Thiel. I know inflation is a big topic for you and your portfolios. How do you handle this rising inflation fear and this rising correlation between equity and the fixed income side?
First of all, that also depends on which sort of portfolios we are talking about. We also do like the commodity space, but we try to invest in that from in the equity space, because we think it's very good for spot inflation rates going up. It's maybe not the best instrument if you have inflation expectations going up. We have invested in linkers, and we also are actively managing duration risks of our portfolios. As I mentioned before, unfortunately, I think this sort of ideal portfolio where you can really kind of get out of the fixed income space to a larger degree that doesn't exist so often. So we have to deal with the fact that for many clients that actually is the space where they're investing, and manage it as best as possible. But it is a challenging time.
Which role could currencies generally play in the future?
We also invest into currencies, and as we've highlighted in the beginning of the conversation, given that nominal rates are fixed across most developed countries, or likely to be fixed at one point if inflation pressures increase, this will lead to the mechanism that FX will play the balance in order to rebalance the competitive nature of the different economies globally, and we're going to see higher FX volatility going forward. So that is then a very attractive space for us in the systematic macro side, where PGIM also is active in, where there's a lot of alpha to be generated.
Yeah, Sebastian, spot on. In our UCITS fund, our core UCITS fund, we don't trade commodities. So FX is actually a really neat way of trying to play the commodity scene within commodity-related currencies. So that's definitely a side note. But as Sebastian says, if we're going to get more volatility in terms of interest rate differentials, currencies will become a really interesting asset class to search for more alpha. And the other thing we have done, again, coming back to the problem about negative correlation, you saw last March 2020, where equities obviously had a bit of a tumble because of COVID. Fixed income didn't do a great job of protecting portfolios. They had essentially a liquidity crunch. So we've done a lot of work on essentially creating new diversifiers. And the one we've created in fixing in currency, is around what we call an FX equity hedge portfolio. Because essentially what that portfolio is essentially we've got 10 very liquid, pretty developed market currencies. And we essentially create the pairs, or pick the pairs that have the largest negative correlation with equities. Now that in isolation is a great, pretty simple concept. But the problem with that approach is you're obviously typically playing away a lot of negative carry. So we want to optimize the most negative correlated currencies, but the first sort of filter we use is the ones that pay away the least carry. And then the third filter we use is essentially those currencies that have the strongest scores elsewhere in the portfolio. So strongest value or macro or trend scores elsewhere. So when you put these three things together, you end up getting a pretty interesting FX equity hedge portfolio, something that has a very negative correlation with equities, but hopefully has minimal carry. But we also like those ideas for other reasons. And that's become a really popular research topic to discuss with clients, but it's also actually becoming, we're increasing the risk to that portfolio quite significantly at the moment, because again, it's just another thing that has a negative correlation with equities that's not driven by fixed income beta. So currencies are a really interesting asset class for us for a couple of reasons. The alpha side, as Sebastian said, but also potentially as a really powerful tool to act as a negatively correlating asset. So yeah, currencies are important for us.
Anna, how do you protect your portfolios? I mean, especially, let's say, for conservative investors, it's a pretty tough environment without a big fixed income bucket. So how can you protect your strategies?
Yeah, it's actually it's depending on our portfolios and on the strategies. Actually, in some of our portfolios, we also can use currencies, and we used them quite well this year. Especially, we added US dollar, as we see US dollar quite a diversificator, especially in terms of if we see rising correlation between equities and bonds and negative environment for these both asset classes because of the negative inflation surprises. We also, in portfolios where we quite flexible, we added some asset classes that have low to no correlation to standard asset classes, for example, like cat bonds. Actually, one asset classes exhibit like really no correlation to other standard asset classes and also gives you quite a nice yield around 7% per year historically, and also the spread of this asset class even increased and get more attractive during the corona time.